Hello traders, you're watching Sydney Direct with me, Natalie MacDonald. Today I caught up with Mathan Somasundaram of Baillieu Holst to talk some of the market action that we've been seeing on the Australian financial markets. Here's what he had to say. Mathan, thank you very much for taking the time to chat to Duke Skilpay TV today. Much appreciated.
Not a problem.
Okay, so Greece is starting to resolve itself. Even Chinese stocks appear to be behaving somewhat. If we're looking at this performance-wise, it's a bit of a Groundhog Day in reverse, really, compared with last week.
It is a bit like that. I think the Greece situation, it was more about the contagion effect. I think when Greece did technically fold and allow pretty much EU to dictate terms, that kind of removed the contagion effect. After that, reality is Greece is still quite small and the effect of that is almost negligible. So the contagion effect is out of the table. So after that, the markets are quite comfortable. With China, they had the property bubble. They used the equity bubble to try and keep the consumers going through. And that's hit a few, I suppose, bumping steps here and there, but it's getting through. The equity bubble, they will manage it. They manage their economy similarly. They'll buy into it, get things stable and move on. It's a different kind of culture. It'll take a bit of time, but we're comfortable that they'll move that along.
How is this shaping investor sentiment moving into the second half of this year, particularly obviously as investors eye up that inevitable interest rate hike from the US?
Yeah, it's an interesting one. I mean, I suppose we're kind of caught between two things. One, we're so linked to the emerging markets because of our commodity-based economy that when interest rates do go up in US, it'll affect the emerging markets, which will then affect us. So even though we are not an emerging country, but we have that risk associated, so we will be affected and that will pull us back. But on the flip side, our economy has, especially our equity markets have a substantially good dividend yield. So on a global sense, we actually have a steady yield concept in our equity market. So that is favorable to global investors. So we will always get global investors coming into Australian markets because of the low growth outlook globally.
The banking sector, sort of as always, leading the rises and the troughs that we're seeing on the ASX. We saw a particularly negative lead off of that, the back of that APRA announcement regarding capital raising. But given that this threat has sort of been on the table for some months now, is this simply just sort of another twist and looping sort of the ASX roller coaster?
Yeah, it is a bit like that. But it's funny how that always happens after when the stocks go ex-div. It never happens before they go ex-div. So they pay the dividends and then suddenly all the scare stories come out and all the hedge funds come out with the story, the banks, the property bubble, and that's always been around. Our banks are quite well regulated, they're well capitalized, and the APRA is moving to capitalize them even further to make sure they're in the top quarter in the world. So in theory, I don't see a huge risk. The big problem for them is the overall economy is slowing down. So banks being such a massive part of our economy, they will slow down as well, and it's going to get tougher. But they're quite well diversified into multiple parts of our business model, so they'll hold up relatively well, and they'll still pay a good yield. So in that context, I don't think it's a huge risk.
You mentioned there sort of some of the scare stories, and we are in confession season now, sort of the calm before the storm ahead of earnings season. Were there any surprises to you, and how does that sort of shape your expectations coming into reporting season?
Oh, well, I think that a lot of the scare stories actually came out way too early. So if you look at, and it happened mainly on the small to mid cap space. So you had all these consumer stocks that potentially a lot of aggregation models we had in Retail Food Group, in Slater and Gordon taking over in the UK side, and then you had things like Green Cross, which is a vet roll-up, and a lot of these roll-ups, education roll-ups, all of these aggregation models, the hedgies got into it, have the scare story, the growth is not there, they're going to struggle, and it kind of makes sense in an environment where there's low growth. So a lot of those stocks have been hammered. They're probably down 30-40%. So in that context, a lot of that scare story is already in the market. The bank scare story has been played out. They pulled back, over 10%. So in that context, that's already in the market. The commodity one, you don't need a scare story. China is there, so whenever commodity prices come back, that just happens. So we've actually got most of the resources that pulled back. So actually, the reporting season is funny because we're expecting a negative one, But I look around at all the stocks. Well, we've already had all the scare stories. There's nothing really that's going to surprise. Our supermarkets are being challenged. Our banks are being challenged. Our resources are struggling. And the small cap, all the scare stories are already out. So really, if someone does come out with the really bad news, I'm sure they're going to get hit at least 10 to 20% because people are not in a forgiving mood. So everyone will jump out because there's a lot of other stocks that are offering good value. But overall for the market, I think the negative news is already out.
Challenges across the board then. Mathan, thank you so much for taking the time to chat to us today. Hopefully look forward to catching up with you again soon. Thank you.
Not a problem.
That's all we've got time for right now, but I will be back with plenty more exclusive insights right here from the heart of the APAC region. So don't go away. Goodbye.